Very good afternoon to all our clientele and to our dear guest, Gianluca Minella. Very good to see you, Gianluca. How you doing?
Good to see you, Antonio. I'm good.
Thank you for taking the time to chat with us for our 20 minutes coffee. And as I mentioned with you, we talk always about global infrastructure. A lot is happening all the quarters, actually. So that's the very good things in keep this door open with you. Let's begin. Gianluca, looks to me that target allocations to infrastructure rose for a third consecutive year. So the growth actually moderated year over year as the asset class actually transitioned from an early adoption to the broader expansion. Do you agree with this, firstly? And if yes, why is happening this in your opinion?
Yeah, sure. So target allocations for infrastructure have grown historically over time. We are talking about perhaps the newest asset class within alternatives after real estate and private equity. But we saw a meaningful acceleration a couple of years ago. And there is a reason for that, namely the fact that on a relative basis, infrastructure seemed to be tactically more attractive than private equity and real estate, which were a little bit under pressure because of higher interest rates, lower transaction volumes, or in the case of real estate, sectors such as office that had been hit heavily by changing behavior, changing consumer behavior. And now, so the asset class infrastructure has broadened from being purely a fixed income replacement to also an equity replacement. And so you have seen that some of the allocation that would have been given to real estate or private equity has flown into the infrastructure bucket. So yes, we have seen an acceleration. Now we are seeing the opposite of it in the sense that as private equity and real estate seem to have reached a point where they're bouncing back, I think what you are seeing is that investors are cautious of that. And also they want to understand, they want to realize what that increased allocations have generated for infrastructure. And we'll discuss a little bit performance later. We expect the asset class to continue growing. Just to give you an idea, 2025 was an absolute record year in terms of fundraising. So over 200 billion. I think out of memory, it was above what we saw in 2022, which was just under 200 billion. 23 and 24 were tough years. And 2026 seems to be along the same lines, seems to be strong in terms of fundraising, although fundraising has become tougher in general. So overall, I would say absolutely right. Structurally, it's a growing asset class. Tactically, you always see that as more and more investors implement strategic asset allocations and total portfolio management, and they become more dynamic, you may see that that growth rate changes alongside the macroeconomic environment and the relative value provided by the asset classes.
Interesting. And now I would like to bring here around the table some view. Let's put like using the world map, and looks to me that something is changing between Europe and US in terms of appetite, let's say, towards this asset class. Actually, I would like to hear your opinion, opportunities and challenges, if you are concretely see some sort of shift towards one continent to the other one. What are you thinking?
Antonio, let me start by saying that private infrastructure is a developed market asset class. despite the growth that we see in Asia, North America and Europe still account for over 80% of overall transaction volumes. As you say correctly, with the new Trump administration, we have seen that policy uncertainty introduced first by the executive orders at the beginning of 2025 and by the One Big Beautiful Bill have really created a shift in appetite from investors. International investors tend to favor Europe again over North America, where the policy environment in Europe seems to be stable, and actually, that stability, which may be a little bit of a function of a slow policy environment, is actually playing in favor of Europe. Now, two very important points. North America remains still the deepest infrastructure market. If you look at transaction volumes, very, very active. And the current environment, including the war and the higher energy prices, which have basically not affected America. Gas prices in the US today are below where they were before the Iran war. Has really accelerated digitalization and data center transactions. All the large hyperscaler transactions are happening there. So you're looking at a multi-billion opportunity set. So that's to some extent something international investors are still attracted to. On renewables, which have been hit meaningfully by the regulation change in the US, we see that now entry returns have widened meaningfully. So for developers that need to develop projects and then sell them to get the liquidity back, they're willing to sell at lower prices. So it's a buyer's market. So fundamentals may be a little bit challenged because of policy, but actually the market is attractive from an entry return perspective. We have seen a widening of over 300 basis points in entry spreads. So you can achieve today with an operational project in renewables 12-13%. Before it was maybe 10, just to give you an idea. So you can summarize it this way: Europe policy stability, weak economic growth, acceleration in electrification because of high energy prices. North America policy uncertainty, less demand that we saw during the Biden era with the IRA, which was a very strong policy push, but at the same time an economic powerhouse, which is really, driving opportunities in digitalization and energy that needs to support this digitalization nevertheless. And fundamentally, while we see the headlines saying that investors have less appetite, when then it comes to deploying capital, we don't really see that on the transaction side.
It's interesting because also at the same time when we talk about infrastructure, it's always a long-term investment usually, right? So also the shift in policy, central policy changes or moves. Somehow, if you have a very strong contract or long-term period, it's something that you can mitigate somehow. But those short noises, that are every 4 or less or 5 years we have with change of administration at the same time becomes somehow a risks. So quality, I would say, probably find the right asset class. It's always the most important element to get a good investment, I would say, right?
Look, we have published recently a long report on policy and regulatory changes in infrastructure. We started in the 90s with changes to Californian utilities. We have gone through, the issues that UK PPPs had with the design of certain projects. We have mentioned, countries like Norway that retroactively changed tariffs in the early 2010s, or Spain and Italy effectively retroactively changing tariffs for renewables. So regulatory change and policy uncertainty is here to stay. As you say, you approach it by diversifying your investment and by trying to sort of like be through the cycle. Also, I think increasingly in base cases, in underwriting cases, not taking regulatory support as the base case, but only as an upside. But look, fundamentally, it's also an opportunity for investors that have liquidity and are willing to take that longer term view. You may be surprised by how many investors are often more worried about the short term, more worried about the headlines, more worried about the reputational risk of making the wrong decision and miss good opportunities. It's a market that is lower than the listed market, but typically when these shifts happen, you see a repricing in the market within 1 year, which gives you opportunities to generate attractive returns if you want.
Indeed. Also, infrastructure portfolios looks to me that they have delivered strong returns for the third consecutive year, almost outperforming other asset classes in the alternative side, I would say. Can you assess this data information a little bit more deeply?
It's a difficult one because it's a multi-dimensional problem. Let me say the following. So if you look at 5 to 7 year returns historically, infrastructure has outperformed private equity. This is because it's been resilient at around 9 to 10% net IRRs, whereas private equity has been hit heavily in the last few years. And that's why, to some extent, we were saying that some private equity capital is flowing into infrastructure because of the mega trends and the opportunity to some extent, mimic private equity returns with lower risk if done properly. But what we are seeing in infrastructure as well is that the opportunity set is shifting towards more capital expansion, greenfield projects, emerging sectors like data centers, which really means that the risk profile of the asset class has evolved too and has gone up potentially. So that's one consideration to make when you're looking at these returns. It's also interesting to note that while real estate and private equity seem to now have bounced back, if you look at fund returns, infrastructure returns have remained resilient, but have come down a little bit in the first quarter of 2026. Why? Because I think higher interest rates take longer to fit through in infrastructure because the debt is longer term nature. So the returns that we saw, the strong returns that we saw in the last 2-3 years, discount perhaps the fact that some assets have not been exited, that the market has been a little bit slower on the transaction side, which we have actually absolutely seen, and the fact that that sort of like debt had to be refinanced, and so the higher cost of debt still needs to fit through. So I would say that probably going forward we may see a bit of a bear bell situation where overall market returns come down for core plus assets, historical returns, whereas entry returns have widened, of course. But overall, the asset class continue to deliver stronger returns because of this substitution in the portfolio from core defensive assets to assets that now are in expansion, like data centers or similar or new power projects, for example.
Got it. You mentioned a couple of major risks, the micro economic side, so the inflation side, the market side. But looks to me that also I would say probably nowadays is almost at the first place, if it's not the second one, geopolitical risk, especially for the last couple of years. It's the one that it's everywhere around, very close to us also, because we have a couple of wars very at our doorstep. While actually the regulatory risk has emerged as a growing institutional concern, as you mentioned before. Especially when we talk about data center developments. Would you agree with this, and would you assess a little bit more about it?
Look, there was very recently a study published by Holtz Whale, that is a consultant on infrastructure risks, and the 3 key risks out of memory they mentioned are geopolitical risk, regulatory risk, so exactly the 2 you have mentioned, and we can briefly talk about them. And then the new one is technological risk. So let's briefly go through these 3. Geopolitics, absolutely. We all see what's happening with the Iran conflict, which seems to have come to a standstill at the moment. But what we have all realized is that energy, trade, technology, deep demographic changes that are rebalancing the size of relative economies are all impacting the investment environment, both in the short term, as you say, there are proxy wars here and there, but also in the long term, there is fundamentally a change with China and North America, particularly the US, really becoming the two leading poles, right, of these two leading hubs of this rebalancing. So it's absolutely something that concerns investors and needs to be taken into account. Regulation, we have just mentioned. To some extent, you can see some of the regulatory changes. Think about trade barriers being somehow a function of what you see on the geopolitical side. So a tool to sort of like have other countries aligning to the US foreign policy. And technology is another topic aligned to geopolitics, because access to technology, think about the AI models, we've seen the US restricting access to some other markets, becoming conditional again to long-term political alignment. Technology is a risk, however, from what I understand, also because of the fact that there is an understanding that perhaps while the fundamentals of AI are strong and it's sort of like an industry that will continue to grow, the financing and valuation side of it are perhaps moving at different speeds, are anticipating some of that growth that may be spread over many years. That could be a concern, because fundamentally an adjustment in valuations in equity markets, driven, for example, by an adjustment in valuation of the hyperscalers or the Magnificent Seven, as we define them, driven by sort of like lack of earnings following the AI capex super cycle they've just embraced, could again create a spillover to private markets. Why? Because private debt has been actively financing a lot of these hyperscaler data centers, less private infrastructure equity, more private infrastructure credit, or private credit in general. And number two, because clearly an adjustment in valuations would impact tactical allocations again, the target allocations we were discussing at the beginning, to a point where, we may end up again in a denominator effect situation where suddenly allocation to private markets needs to slow down because your listed liquid balance sheet has potentially repriced. So these are the topics that are on the investors' forefront when they are trying to think about the broader environment at the moment.
Lovely. Always very juicy. I appreciate very much everything that you share with me, with us. So a lot to digest, of course. Do our homeworks in taking notes where actually to bet. Of course, we talk every quarter, so it's not something that you can solve in quarters, this one. But we have to think also strategically, much more in the long term, but analyzing the tactical one, not the shorter one. And I appreciate very much, Gianluca, your efforts in giving us insights to think better. I wish you a very good, let's say, summer. We are not talking about summer break because we don't know, but summer that we are feeling it, especially here in London. It's pretty warm, and we're going to talk again pretty soon in September. Appreciate it.
Thank you very much. Bye. Take care.
Bye. Thank you.